Hey everyone, FinalBoss here. Today we're going to talk about how to find high probability setups. Go.
All right, guys. Well, today we're going to be going over a really important concept in trading, and we'll actually be learning a strategy called confluence trading, and it'll give us an opportunity to find high probability setups. And of course, finding a high probability setup itself is not the whole of trading. So by the end, hopefully, we'll give you some examples of trades and how we would set up risk and reward. And my hope is by the end of today's session, you'll have a lot more confidence of how to approach trading and even give you an opportunity to develop the skill set to actually find trades yourself. And you can also go take the weekends to study and find these high probability setups. And of course, this is recorded. You can look over this video again if you have any questions. Of course, you can DM any of the mods here. And hopefully this will be a really helpful webinar for you. All right, so today, finding high probability setups. All right, so the question to begin with is what is confluence? All right. Well, confluence in trading involves combining multiple techniques and trading methodologies to help identify decision points in trading, right? And put simply, confluence traders take trades when there's multiple multidisciplinary reasons to be in a particular trade. Most of the time, it starts with technical analysis. Sometimes you might start with technical analysis, maybe different kinds of technical analysis. Maybe on one hand, you use moving averages, and then you have, ACFL is telling you about the trend lines. This has happened to me actually on more occasions than one, because I use a lot of moving averages. I also use a lot of pivots. And so I'm already looking at a trade and thinking, you know what, this might be a long or a short. And then you have ACFL come out and say, hey, there's a trend line. He's doing his analysis there. So that gives me even more confidence, right? Then maybe MK comes out and helps by saying, hey, you know what, there's even option flow on something. So that gives me even more confidence, right? Right. Sometimes we use fundamental analysis even, right? I'll give you a good example. Maybe the euro over USD trade. I am increasingly confident that the dollar is going to go up, right? So as well as using technical analysis for my entry, I have confidence that the Federal Reserve is going to, it's going to try to prop the dollar up, right? Or to some extent, even when FinalBoss is trading small caps, he does look at the numbers, right? He's looking at how much cash these companies have, right? That's not a technical analysis. That's a fundamental analysis to a degree, right? And of course, finally, there exists even arbitrage between assets. You'll often hear me having the option and the stock and trying to find some sort of inefficiency between the two. In any case, confluence trading is when you have a lot of disciplines and you have more than one reason to be either long or short or whatever, right? Well, today we're just going to be looking at chart confluence. It's just a subsection of technical analysis. We're just going to be looking at the chart and seeing, are there multiple reasons to be long or short, or maybe no decision, right? Sometimes the chart will show you that you shouldn't be acting, and that also is valuable information, right? So today we'll be looking at the 15-minute candlestick high-low. We'll be looking at the VWOP and how that works and how at least I use it. We'll be analyzing certain phenomenon regarding the 9 EMA, and we'll also be hopefully looking through the 9 EMA, 20 EMA crossover. If you've never heard of these, it's fine. Hopefully by the end of today, it'll open your eyes to some good opportunities. All right, so before we get into it though, I did want to give you some warnings regarding technical analysis and charting. All right. It should be noted that technical analysis is phenomenological. It's not merely mechanical or systematic. All right. What do I mean by this? Okay, a phenomenon is like a force of nature, right? It's like a hurricane. If I were to say this is how a hurricane works, I'm not trying to say that it mechanically works like that every time. I'm giving you broad generalities. I'm giving you broad descriptions of how this phenomenon tends to play out. It's a very chaotic phenomenon, right? In the same way, technical analysis isn't a purely systematic or mechanical endeavor. It's a way of trying to establish tendencies, right? Generalities as to how price tends to behave, though it doesn't always play out that way all the time, right? Secondly, respected elements of any chart, well, they change depending on the shifting sentiment of the market. What may, for example, function as support on any one day, if given the right breakdown and given the right sentiment change, suddenly people get really spooked out and people are very scared. That support might now become resistance. You can actually, that's not an uncommon thing to hear. I think a lot of people get started in technical analysis, they're very confused by that. Like, how could something that used to be support now be a resistance? That's almost like you're reversing. That sounds like you can make technical analysis anything. And they start to kind of get disillusioned with technical analysis. And to that end, I would simply add that, yeah, it changes on according to the sentiment. And you have to be willing and open to change our analysis. Um, Given the scenario and given the circumstance of your times, right? We have to evolve. I like to say, like Bruce Lee says, you need to be like water, right? You need to change and be willing to change. It's not a pure mechanical system. It's almost an art. Right? Technical analysis signals. What do they do? Do they give you a sure shot buy and sell? No, they generate probabilities, not certainties, right? We've talked about that in the past, right? That trading is about probabilities, and that's what technical analysis gives you, a higher probability situation, but it's not a certainty. To me, this is an important point. Number 4, technical analysis provides insight into the psychology of your counterparty. Whenever you make a trade, there's a buyer and seller. If I'm buying something, someone is selling it to me, right? Well, when I'm buying it from that seller, I'm doing so trying to think, what is my counterparty thinking, right? And that's going to provide insight into the psychology of how I should operate in my trade, right? It would help me to understand, okay, if my counterparty is selling it for XYZ reason, essentially, I am saying that his beliefs are slightly off, right? And that I believe price will behave a different way, XYZ ABC way, which is different from what my counterparty thinks. Well, technical analysis helps me to understand whether he's right or she's right or whether I am right. And it allows me to manage my trade accordingly. Next, no matter how strong confluence, conviction behind a trade may be, the bottom line, though, is that risk management always rules, right? Technical analysis doesn't generate blind signals. They inform you where you should make a decision. And there are 3 possible decisions. You can either buy it and put a stop below, or you can sell it and put a stop above, or you can do nothing, right? Notice how in the first 2 situations, I still use the stop. I'm still position sizing, right? And if you have any questions as to how you put a stop and how you position size, you can refer back to the videos that we've already covered on position sizing and risk management, right? Or you can always DM one of the mods. All right, with that said, let's move on to then the 15-minute high-low. All right. Now here are 6 tendencies or phenomenological general truisms about the 15-minute high-low. What do I mean by the 15-minute high-low? Well, every single 15-minute chart is filled with candlesticks, each candlestick representing a 15-minute time interval, right? Each candlestick represents 15 minutes, you can see here, right? And every 15-minute candlestick has a low and has a high, right? Every candlestick has a low and a high, a low and a high, right? This candlestick also, a low and a high, right? So that's what I mean when I say the 15-minute high low, right? That's what I mean by the 15-minute high low. So that you understand, every single candlestick has a high low, and right, we're going to go over 6 truisms regarding that 15-minute high low. Okay. Now, it should be noted that this is a general truism, not for small caps. All right, this is for large cap stocks. FinalBoss and I, and the rest of the mods, we all will continue to inform you that playing the small cap stocks is a different animal altogether. Right, it's a completely different game with different time horizon, with different agenda behind the price action. Usually, there's someone behind the price action, and they have an agenda. Very different for large cap stocks because just as there's more players in large cap stocks, there's a lot more liquidity, and if you operate according to game theory, there's just so many fewer things that someone can do to manipulate the stock, right? So this is a general truism just for large caps, and the idea is that that price tends to respect the 15-minute highs and lows of the candlestick, meaning there are often decision points that can be made at a 15-minute high and a decision point that can be made at a 15-minute low, right? They provide opportunities, second point, for entry and risk management, right? You could, upon a break of a high, you could potentially consider going long, let's say, and then put your stop at the 15-minute low of that very candle that you're on, right? Or if it's breaking down, you could decide to go short and to put your stop at the high of that 15-minute candle, right? And I'll give you examples by the end. Something also important is that this 15-minute high-low perspective presupposes that most stocks on most days tend to trend. Okay, they tend to trend, meaning you'll get multiple 15-minute candlesticks moving up in succession, creating higher highs and higher lows, or you'll have multiple candlesticks, 15-minute candlesticks moving down, creating lower highs and lower lows in succession. This is a momentum stock, right? A lot of these large cap stocks tend to have this sort of momentum that continues to move up multiple candlesticks in a row, or continues to move down multiple candlesticks in a row. And this works especially well, point 4, on what are called outside days, meaning the price is trading outside of the range of the prior day, right? So if, for example, Apple was trading from $98 to $100, and let's say today it broke out above $100 and now trading at 101, 102. Well, when it has traded outside of the yesterday's range, that's when we start to get kind of trending behavior, right? And this is especially when 15-minute high-low analysis tends to be true. It should be noted that the 15-minute high-low perspective doesn't try to predict price action. It's actually reacting to price action because you're not anticipating an event. You're simply trying to establish when some high has been made or when some low has been made. Okay, now next thing we're going to be looking at is VWOP, right? VWOP is one of the most famous indicators that are used by day traders. It's as easy as going to your technical analysis setup in your charts, and it's almost guaranteed you'll have a VWOP that you could put into your charts. All right, and here are some general truisms regarding VWOP. Price action above the VWOP tends to favor buying, and price action below the VWOP tends to favor selling. All right, before I get people yelling at me angrily saying that's just not how you use VWOP, okay, I'm simply highlighting general phenomenological trends. Of course, there are situations when VWOP is used differently, but generally, that's how I think about VWOP and how I use the VWOP in a confluence of many other indicators. VWOP serves as a line in the sand, right? It can be used as support or resistance alongside other technical analysis chart patterns. And VWOP represents a possible decision point. It's not necessarily a buy signal or a sell signal. It's simply a place where traders will look and say, hey, This is an important moment. I should consider taking an action, and doing nothing and sitting in cash is also taking an action, right? But at least at that moment, as it's hitting VWAP, I'm thinking about how the VWAP relates with other formations that I'm looking at or other analyses that I'm employing, right? It's at that moment that I'll say, should I be buying this stock at this point? Should I be selling? It also gives us me a reference, right? For example, if I'm going long above VWAP, it's not uncommon for me to put my stop below VWAP, right? Because it's the line in the sand, right? So that's how I usually use it. And I'll give you examples of this later on. Next is the 9 EMA. Again, you can reference this in a video that we'll be recording. And so I'm going to go through this quickly and then I'll give you some examples at the end. The 9 EMA, the letters EMA represent exponential moving average, okay? And here again are some observations that I've made regarding the 9 EMA that I employ on a daily basis. First is that price rarely deviates too far from the 9 EMA, all right? Many momentum traders and algos use the 9 EMA as a decision point for entry, exit, or to hold, which is why the break of the 9 EMA often marks the beginning and the end of a new intraday trend, right? 9 EMA often is also used to define the front side of a move and the back side of a move. You'll often hear this when the price is bouncing above the 9 EMA, it's on the front side. And then when it breaks below the 9 EMA and starts to trade below the 9 EMA with the chart falling and looking a different way, looking a little bit more broken, you'll hear traders say, oh, it's on its backside now. And for a lot of those traders, they use the 9 EMA to determine whether it's front side or back side. And it's important to recognize this because price tends to behave differently depending on which side you're on, right? If you're on the front side, the 9 EMA is used more as a momentum tool to know when to long or where to put your stop. Maybe if it's on backside though, it allows you to know when it's time to get a good short, or when it's time to use that 9 EMA not as a support, but now as a resistance. All right, so that's the 9 EMA tendency. And then we're gonna measure the 9 EMA relative to the 20 EMA. The cross of the 9 EMA over the 20 EMA often represents a key decision point for traders. And the second point is that the 20 EMA's behavior and effect on a stock often changes according or depending on the price's relative location, which is why a lot of people who use 20 EMA often get dumped on, often get stuck in trades, right? So you want to use the 20 EMA in a very particular way, not just simply a support or resistance all the time, all right? Okay, so to that end, we're going to look at some confluence examples and some rich risk management techniques. This is where we actually go through a strategy together. In fact, it's a strategy I use all the time.
All right, this is just an example of the kind of videos you're going to get in our Discord. If you want to see exact examples on how we use 9 EMA, the VWOP, and the 20 EMA in real life scenarios with true examples, we have member exclusive videos that you can watch once you join. Now again, it's 7-day free trial, so there's no risk to you. Join, give it a shot, don't trade alone, join us as we do this every single day.